Good morning, ladies and gentlemen. Well, our risk model is still firmly stuck in negative territory. We closed the week at -43, and if we want to have a look at what it's doing on a weekly basis, we look at the weekly model in the box, and it shows you that basically we've closed exactly where we closed mid-January, i.e. 2 weeks ago, at -43, identical score, even though the market is substantially higher. I have looked at every single internal of the scores, and they are now at very critical levels. I can say without any fear of contradiction that in the next couple of weeks either this score will go positive or it will go full negative. There is very little in it, as it were. So we are at very crucial levels, and we can actually now go and look at the charts and see why that is so. As always, we start with the bond market in the States. What is interesting here, and you will see this in not only in the bond market but also in the equity market, is this sharp contraction of the Bollinger Bands, which happened on Friday. It happened in all asset classes. What that says is technically the market will now range trade within a narrower band as these Bollinger Bands contract further for a few days or even a couple of weeks before a large move gets underway. For the time being, this yield of 254 in the 5-year note, and if we look at the 10-year note, we will see much the same. This kind of level, 271, 270, 271, 272 is going to be very, very crucial. You can see a whole load of highs and lows at that level. So 271, 272 will probably trade for most of the week in the 10-year note. The US bond market is actually being completely straitjacketed by what is happening in Europe. The bonds and the whole of the European bonds are holding the treasuries within a -259 to -247 range. That is a 10 basis points range, and you can see how long we've been in this 10 basis point range. We dipped out of it and the dollar strengthened. We went back to it and the dollar weakened. Now we could be in a prolonged period of consolidation on, forming a right shoulder, maybe, who knows. But while we are within that kind of a very tight trading range, it's very unlikely that bonds are going to make a very large move outside of the risk tolerances and the Bollinger Bands I just showed you. Another fundamental reason why the equity market and the risk markets in general would be quite contained to the upside is because we are rapidly approaching the time 16 Blue Angel, which is descending. You can see what happened here back in 2015 when we did that. There was a lot of basically staying around and not breaking higher. That level corresponds to approximately 27, 30, 40 here on the at the time 16. And as you know, 27, 25 has been such an important level for such a long time because it is the point of control for the whole of 2018. It is very unlikely and very bad risk reward to play anything above 27, 25 for the foreseeable future. And here we go with the monthly analysis of the ES, SPX. You can see where we are. We closed the month right at the very important line of the moving averages, and here we are with a descending moving average hitting it. We have always traded very well within it. This is crucial level right where we are. That is why I think it's very unlikely that we stay above that level with any conviction for the foreseeable future. We are more likely to have dips towards the 2650s rather than anything much higher than 27, 25, 27.40, where the 200-day moving average is. I think this moving average, which is descending, and this red one are going to act as magnets, and all month we will be pulled back towards this 2700, 2710 area. On a weekly basis, you can see that we've had 1, 2, 3, 4, 5, 6 weeks in a row of higher prices, people covering their shorts. But even here, the moving averages are rapidly coming in to cap. This 2730 level is going to be very hard to break. In my opinion, we are more likely to have breaks back down rather than sustain any move above 2730. To me, it is very unlikely that we have much more than another single green candle before we probably have a couple of red candles onto the downside to about this level. 26.25 looks ideal. That is probably what we're going to get. And as I keep on saying, now we need data. This market now needs to take a breath, needs to take a pause and get some data which will either turn the Blue Angels to the upside, i.e. better earnings, better growth, a stronger economy, or a confirmation of a weakening world economy which will make us go down and retest these lows. On a daily basis, you can see the movement in the Bollinger Bands, especially if I enlarge it. That to me suggests that we are very, very close to a top, if not at the top. I would love to see the market come and retest this green line, which in the next few days I guess is going to be somewhere around the 2650 area. That is my objective towards the downside, basically meandering between this high level of 27.25 all the way back down to 2650. A 2.5–3% trading range, which for the next couple of weeks would give us time for the internals to decide which way they want to then break, either back down or up, and probably certainly towards 2800. So that would be the next objective. If the risk scores turn positive in the next couple of weeks within the consolidation here, 2800 and gap fills, numerous gaps that we have here are going to be the first target, followed by 2861, which will be the very, very important level. But I don't expect that to happen for a protracted period of time, while the internals go the market goes sideways and the internals decide which way they're going to go next. Even if we look at other markets like EEM, we will see that here we are at the top of the weekly Bollinger Bands, having really gone from the bottom of the Bollinger Bands to the top of the Bollinger Bands. Really a move back to this kind of level, the 41.40 or even 41 even, really would not shock. In fact, it is the higher probability play. So that matches the analysis in SPX. I love this chart of the stocks because it seems to match so well with the highs and lows within these fork type patterns. If we now enlarge this, what will we see? We will see that we have a line coming in at approximately 32.30. That to me is going to be the absolute top in the European markets. I would love to be able to short something in the 3200s because I'm quite sure that I will see this kind of level 3100 again. So that is what I'm looking for. I'm hoping that we see something in the above 3200, 3220, 30. I would love to have some option plays there for the downside down to 3100 at least. Even the Nikkei has got this Bollinger pattern. All the markets do. To me, this is a sign that there isn't enough impetus, there isn't enough strength for the equity markets to break higher, and therefore what doesn't go up tends to go down. I would have thought the Nikkei at some stage over the course of the next week or so will trade again at 20,500, and then we decide what we do next. So same pattern in nearly all of the equity markets, suggesting that they reinforce each other. And this pattern of the Bollingers is actually present here in the VIX as well. Everything coinciding, isn't it? So if we have a look, we'll see that we are right on top of the 200-day moving average. We are right on top of the Bollinger Bands in VIX. So would a move back up towards the 1930 level surprise? Not at all. That is why it is now very bad risk reward to be long of equities and short of volatility. Not saying the volatility is going to explode, anything but a move into the mid-19s is playing the risk reward game. Onto the dollar, and remembering what I said last week about how the dollar is coming into some very exciting times and possibly opportunities, but we will let the market decide for us. Here we are right on top of the 200-day moving average. We have, even here, we have contracting Bollinger Bands. We have this all-important 95.07 level, which is right in the middle between the 96.50 and the 93.63, which is going to be so important. I think if we see 93.63, we're going to have an explosion in volatility in FX. So a few days of moving sideways and then deciding which way to go. Basically, there is nothing that we need to decide what to do this week in any asset class, because they're all reinforcing each other and saying we're going to go sideways and back and fill. As I told you a couple of weeks ago, gold has sort of piqued my interest because I would have thought it's some kind of a leading indicator on the dollar. I'm not a great expert on gold, and I hold a little bit of gold, and I've upped my allocation to gold very slightly, but that is just a technical thing rather than anything important. I just think that we are now in a triangle, which, you know, we'll probably come back towards the 1300 level, backing and filling, but it just shows an explosive potential sometime later on in the year, simply because this is becoming untenable. This is like a 3-year sideways pattern which will break consistently either on the upside or on the downside. It's a triangle. When we start breaking above 1400 and holding 1400, 1500, that's going to give us, you know, targets in the 1800s. And that is what I'm looking at, because I'm looking for this volatility to happen in FX. And this to me is a leading indicator of volatility returning in FX. I will not short volatility in FX from now on for the next considerable period of time until I get a different read from these markets. At the moment, I'm very much being told play the FX side of things via long volatility as opposed to short. And if we have a look at one of the main components of the DXY, which is the euro, again, you will agree with me that this is becoming untenable. This very tight range that we've had here for such a long time is really coming at some stage to a conclusion. These Bollinger Bands are coming in and coming in and coming in on the weeklies, and at some stage the market will no longer be contained from this very long-term 200-week moving average, you know, just in the 112s, and these levels here in the 116s, 117s. At some stage in a few weeks' time, we're going to break. And when that happens, it's going to be a very big move. The market has been in this range for the best part of 2 years. And when that happens, the break is going to be vicious one way or another. That's why I think volatility will be the driver. From a macro point of view, what can I expect? I can expect something like the US going into a recession sometimes towards the end of the year, and the administration deciding that the best way to hold up SPX is by letting the dollar go. And when they let the dollar go, they don't let it go for 1, 2, 3%. They let it go for 10%, 15%. That is what the macro explanation could be. That could be my favored answer, but I'm certainly not gonna wager any money on it until I see price and events confirming it. And finally, onto the biases. Nothing really changes in the bonds. The levels remain much the same. SPX, 26.77, 27.25 for a couple of days, then dipped down to 26.50. That's the kind of market play that I expect over the course of the next couple of weeks. If it starts going consistently above 27.25, then we really have to reevaluate everything, because something else, something different is happening, but I do not expect it. NQ, I really would not want to be long of it. It just has lost all leadership. I'm not looking to it for leadership anymore. I don't see the point of playing it anymore on the upside. I prefer to use it as my downside in case I'm bearish of SPX. I showed you VX 1650, 1608. We are there, give or take 10 ticks. It's not important. I just can't be short of it now. And if I can't be short of it because it's bad risk reward, then I can't be really long of SPX or NQ. As simple as that. I think for the next couple of weeks we are going to be more to the downside than to the upside. European equities, as I said, anything above 3200, I'm looking to do some put spreads, and I will tweet about it. The dollar, I've told you what I think. 93.63 is a very, very important level, but so is 95.07 now, because we are above that is where the 200-day moving average is. That is where the Bollinger Bands come in. I don't expect that to be broken. The downside, I expect consolidation higher in the dollar for the next week. But if it starts breaking that and going towards 93.63, well, when it starts doing that, we will know that something very, very big is afoot. Thank you very much indeed, and tweet to you on Monday.